Hello, we are Team 3 of Behavioral Finance and FinTech course, and we are going to start our presentation. We decided the business model of social entrepreneurship startup that helps correcting the biases of investors and gives our suggestions to governmental agencies rather than making profits. This is table of contents of our presentation. First, we will introduce the behavioral biases that individual investors usually show in their investment decisions and anomaly that are usually shown in Korean stock market. Then, we will show how these behavioral biases and following anomaly make impact on our society negatively. And then, we will suggest our strategy to reduce the biases. And finally, demonstration of our suggestion and challenges will follow. First, the behavioral biases we are going to deal with are limited attention and representativeness. Limited attention means investors make their investment decision just based on trading volumes or return on investment rather than are easily observed without considering on many other investment options or other index such as PER. Especially individual investors are limited in the data in both quantity and quality. Also, since they are limited in time and the ability to interpret data properly, limited biases usually appear in individual investors rather than institutional investors. Second one is representativeness biases, which is projecting characteristics of few samples into whole population. For example, if there were several cases that IPO stocks record upper limit price and investors make their investment decisions regarding every IPO stock will record upper limit, they are making representative biases. These individuals' behavior biases often lead to market anomaly. Particularly, the anomaly happens in the stocks that are undergoing IPO procedures. This is because there are articles if the company decides to go public, the newly IPO companies' stocks often record upper limit price twice or third these days. So public can be easily attracted by the information and make their investment decisions.
Next, we will demonstrate the behavior biases are observed in the market. Since the outbreak of coronavirus this year, a lot of liquidity has been supplied to the stock market due to the expanding monetary policy. So this limited attention phenomena can be more clearly confirmed. This phenomena can be observed by looking at the four representative stocks in the domestic Kospi and Kosdaq markets, such as SK Biopharm, Kakao Games, Big Entertainment, Gyeocheon FMB, that has conducted IPOs this year. Comparing the offering price, the highest transaction prices since the initial public offering and the latest prices, it can be seen that the volatility is very high until those stock prices arrive at current fair stock price. The table in the slide shows that the volatility of the four companies. When comparing the highest transaction prices and initial offering price of these companies, a simple average of about 275% comes out. Considering that the public offering price is calculated based on market capitalization and compared to the performance of the same industry, it can be observed that there is excessive volatility. Assuming that the current price is the appropriate price of the company, the comparison of the highest transaction price shows that the highest transaction price was traded at about 75% higher than the current price. These results clearly illustrate the limited attention of market participants into IPO companies when conducting IPOs. As we mentioned earlier, newly listed stocks attract great attention in the market, such as high trading volume at the beginning of listing or reaching the selling price. Stocks that individual investors can be easily interested in, make individual investors' decision making more impulsive, and those decisions increase the initial volatility of IPO stocks. It is analyzed that the higher the purchase ratio of individual investors, the higher the variance of the return. Also, individual investors buying activities affected by investor sentiment are performing poorly in terms of yield.
These individual investors' limited attention behavior on IPO companies creates social problems. Most of all, because the initial volatility of IPO stocks is high, investors tend to hold and sell stocks in the short term, which can lead to a speculation behavior rather than investing in stocks. In addition, since institutional investors who can analyze the investment behavior of these individual investors often sell IPO company stocks in the short term, the gap between individual investors and institutional investors in return inevitably widens. This excessive high valuation of corporate stock prices at the beginning of the IPO could cause distortion in the entire IPO market and cause inefficiency in the market where intrinsic value does not reflect stock prices. Particularly, the companies intend to IPO have desire to secure as much funds as possible by raising the public offering price. So, it is likely that they adopt a securities company who offers the generous evaluation. However, if individual investors make economic decisions based only on transaction volume and initial rate of return due to limited attention rather than precise information on the company's stock price is more overvalued and it takes longer to accurately reflect the intrinsic value. It seems necessary to intervene by government agencies in order to protect individual investors and establish a healthy IPO market. Our suggestion on government agencies is comprised of two ways. First is making the policy to give some warnings to individual investors who are willing to invest in IPO companies. We thought best warnings for investors is making a checklist with a sentence of warnings and let them check on box to find out they clearly understand the risk related to their investment decisions. Second is providing obligatory financial education to the individual investors about basics in investment. The checklist contents boil down to this. If the investors check on the checklist well, they can move on to their investment. The intention for this checklist is make the investors to reconsider about their final decisions and plays a role in final warnings for their expecting losses. We also recommend a policy of obligatory financial education on the individual investors, especially investors on IPO companies. Therefore, those who complete the obligatory education course are qualified for investment. The contents of education are as follows: demonstrating the business biases, biases the individual investors commit, the overall procedures of IPO, how the IPO offering price is confirmed. We think it will be more effective if underwriting companies organize and distribute the educational documents and train the prospective investors themselves. It would be better if educators emphasize the several cases that individual investors suffer serious financial losses due to their behavioral biases.
To support the validity of our suggestions, we investigated some research. According to the research by Miller and Marcoux, the explicit warnings are effective in reducing individual behavioral biases. To conduct their research, they set whole population of professor of business administration and the students, and one of the population group was required for calibration without any warning, while the other was because the questionnaire was designed to be calibrated at a level of 90% reliability, it was possible to measure their overconfidence. For the first group that did not see the warning statement, the average value of calibration was 3.03 out of 10. And for the second group that saw the warning statement, average was 3.6 3.67 out of 10.